Hi, you're welcome to episode 5 of Making It Count, Legal Accounting Made Easy with Benji. My name is Benjamin Ofeado. On our previous episode, we looked at various accounting concepts or principles which underlie the preparation of financial statements. In this episode, we'll be looking at the accounting cycle and equation. And by the time we are done with this lesson, we would have been able to cover what the accounting cycle is and its details, and also what the accounting equation is and its meaning. We would have also been able to establish the impact of various transactions on the accounting equation. If you're ready, let's get into it. So, what is the accounting cycle? If you'd recall, in our very second episode, we looked at the definition of accounting. And if you'd recall, we said it is a mechanism or system for initiating, recording, processing and classifying, summarizing, and reporting financial transactions for the purposes of communication, analysis, interpretation, and decision-making support by various users of financial information. In this definition, you'd realize that there are 5 activities therein, which is the initiation, recording, the processing and classifying, summarizing, and reporting of financial transactions. These activities, from beginning to end in that order, is what together constitutes the accounting cycle. So the accounting cycle is basically the set of activities from initiation to the reporting of financial transactions. I hope that's understood. You would also recall that from our previous episode, when we spoke about the various concepts underlying the preparation of financial statements, we spoke about time interval. And we said that typically the time interval for reporting financial transactions or financial information is a 12-month period, or what we would call a 1 year or a 1 calendar year. So typically, the accounting cycle would be a 12-month period, by the end of which we should be preparing financial statements and reporting them. However, we have also indicated that for management purposes, internally, financial statements could be prepared on a 2 times per year basis, or on a quarterly basis, or even on a monthly basis. And we also indicated that now, with the enablement of technology, financial statements could be prepared on even a weekly or daily basis. And so, the accounting cycle could travel a year or even a much shorter period. So that is the accounting cycle. Now let's look at something. We spoke about 5 activities: initiation, recording, processing and classifying, summarizing, and reporting of financial statements or financial transactions. Each of these activities require certain documents or books to enable them to be done. So let's look at initiation. How do we initiate financial transactions? So financial transactions are initiated with what we call the source documents. The source documents. And these source documents vary widely from an invoice, which is evidence of a certain liability that needs to be met by virtue of carrying out a transaction. So it's a document which conveys the details of the transaction that was executed, the quantities, the unit cost, and the amount, total amount thereof, as well as statutory payments like taxes. So an invoice is a type of source document. Then we even have a voucher, a payment voucher. So it evidences the payment that has been made to a party involved in the transaction. Or even we have a check book. So a check that is issued, that could be a source document. There are those things we call purchase order or a sales order. So a purchase order will be an instruction coming from a customer asking that you provide a certain service or goods to that customer. So it is an order requesting to make a purchase. As simple as that. And I'm sure by now you know what a sales order is. So a sales order is one which goes out indicating that we are going to make a sale of this value to you. As simple as that. So these are source documents which are used to initiate a financial transaction. I hope that is clear. Good. So now that we've looked at the initiation, how do we record financial transactions, which is the second activity? So when it comes to recording, we would record the financial transactions at first instance in what we call books of prime entry. Books of prime entry. I will explain that. Prime entry means the first time of entering a transaction. So prime entry, the first time, prime, first, primus, right? Entering a transaction into the books. So the books into which we make those first time entry are those we call the books of prime entry. And what are some of the examples of such books? We have what we call a cash book. So a cash book will basically record all transactions as they do happen. So you may have a bookkeeper in, let's say, an accounting department or accounts department or a finance department whose work is to ensure that once a transaction happens, immediately there's a record of it. So you can have an account clerk doing that kind of work. So they will record it in the books of prime entry. Now, with the enablement of technology, some of these transactions don't have to be entered into physical books, but they can be recorded into books which are technology enabled. So those are the books of prime entry. So recording is done in books of prime entry. Now recording has been done. Now the transaction has to be processed. So once the transactions have been recorded in the various books, now they need to be properly assigned into various accounts that they belong to. So I'm sure by now you are hearing the word classification, where we classify financial transactions into the books that they are supposed to be sitting in. So for instance, if you buy an asset and you make payment for it to the tune of, let's say, 1,000 Ghana cedis, it is important that you record that transaction in the asset account. The asset that you bought, you record the transaction in that asset account. Also, because you made payment for it, you need to reflect it in the account from which that payment was made. So it could be your bank account or your cash at hand account. So you see, you have originally recorded it in the books of prime entry, every transaction. But now, specific to the account that is impacted, you need to now record the transaction into those designated accounts. And those accounts are what we call the principal books of accounts. Principal books of accounts. So you could have a cash account, you could have a bank account, you could have an inventory account, You could have an expense account. You could have a revenue account. So those are the principal books of accounts. So that is processing and classifying. So that's the third step done. Now the fourth step, if you would recall, is summarizing. So at the end of the accounting period or the reporting period, you now have to close the various principal books of accounts. And the balances in those accounts, you will summarize them in what we call the trial balance. The trial balance. What is the trial balance? The trial balance is basically a statement which summarizes all your principal books of accounts and their balances thereof. And their balances thereof. You'd recall, again, that we mentioned about the dual nature of transactions as part of our accounting concept. And we said that for every transaction, there's going to be a debit and a credit. So, on the face of the trial balance, you are going to have a list of accounts and then two other columns where you are going to be having values. One with the heading debit, the other with the heading credit. So these accounts are going to be having balances either under the debit column or the credit column. At the end of the day, on the trial balance, the sums or the totals of the debit column and that of the credit column should be equal to each other. And that is one of the ways to test, or the sure way to test, if your trial balance is correct. So that is the trial balance for the activity of what? Summarizing. Beautiful. So now the very final step is reporting. Reporting. And from our previous 2 episodes, we spoke about the financial statement and how it is presented. And we learned that according to Section 127 of Act 992, which is the Companies Act of 2019, there are 4 main statements. That's the statement of financial position, the statement of comprehensive income, the statement of cash flows, the statement of changes in equity, and then there will be the significant accounting policies as well as explanatory notes to the various statements aforementioned. So the 5th level of reporting is done in these various statements. I hope this is clear. So let's do a quick recap of that, mapping them. So initiation is to what? Source documents. Then we have recording is to what? The books of prime entry. Then processing and classifying is to what? Principal books of accounts. And then we have summarizing, which is to what? The trial balance. And then the final one, reporting, which is to the various financial statements. I hope this is clear. That is the accounting cycle. Now let's move to the accounting equation. What is the accounting equation? Think of this story. Mr. Bonsu decides to start a business. Mr. Bonsu decides to commit 500,000 Ghana cedis as his financial commitment to establishing the business. That amount that Mr. Bonsu decides to commit to the business is what is called capital. Capital. However, once Mr. Bonsu commits that 500,000 cedis to the business, and we learned from our accounting concept, the separate legal entity concept, that the business is separate from its ownership. So that money has come in as capital, but it is also received as an asset to the company. So Mr. Bonsu has set up Bonsu and Sons Company Limited. So Bonsu and Sons Company Limited has capital of 500,000 cedis, but has also received cash of 500,000 Ghana cedis. And now the company decides that it needs to now purchase certain assets, but it cannot use the money that it has received as capital solely to acquire that. So the company is going to borrow another 200,000 Ghana cedis. What the company ends up doing is that it is going to incur for itself a liability of 200,000 due to the bank from which it's going to make the borrowing, but it would have also received cash, which is an asset to the company. What does this story tell us? Three main elements. There is capital, which is money coming from the owner of the company, or the owners, the shareholders of the company. There is assets, which is the economic resources that are controlled by the company. And then there is the liability, which is the obligations that the company has towards its lenders or creditors. Three elements: capital, assets, liability. These three elements are what are summarized in what we call the accounting equation. And the accounting equation is rendered this way. Assets are equal to capital plus liabilities. Assets are equal to capital plus liabilities. Why is this rendered this way? Look at it this way. How do you see the company? You see the company in the economic resources that it controls and uses. All right? So those are its assets. So the assets will represent the company. But then how are the assets financed? They are financed from the contribution of the shareholders or owners, which we call capital, and the loans or credit that it will take from its lenders and creditors, the liabilities. What in essence the accounting equation tells you is that the assets of the company are financed by the contribution of the shareholders and the lenders and creditors who lend to the company. As simple as that. The assets representing the company is financed by the contribution of the shareholders who are the owners of the company, and, which is the plus, the contribution or the loans and credits provided by the lenders and other creditors. That is the accounting equation. Assets equals capital plus liabilities. I hope this story makes sense and you remember it. Good. Now let's look at the final thing. When a transaction happens, how does it affect the accounting equation? How does a transaction affect the accounting equation? Let's go back to our example of Mr. Bonsu or Bonsu and Sons. So Bonsu and Sons was set up with capital worth how much? 500,000 Ghana cedis. So at this point, capital will increase by what? 500,000. And then on the other side of the equation, assets will increase by what? 500,000. And the asset here being what? Cash, which is received. So you see, at this point, the accounting equation has become asset, which is worth 500,000, is equal to capital, which is 500,000, plus liability, which is 0. So we realize that the left side 500,000 is equal to the right side 500,000. Does that make sense? Good. Now, the company decides to go for a loan of 200,000 Ghana cedis. What happens? All of a sudden, the liabilities surface. So there's a liability of 200,000 Ghana cedis because it's a loan. It has to be paid back. It's an obligation to the bank. So the loan will go up by what? 200,000 Ghana cedis. And then, once they've gone for the loan, they have received cash. So that would also come into the assets, which will be worth how much? 200,000 Ghana cedis. So now the equation is going to become 700,000 for assets is equal to 500,000 for capital plus 200,000 for what? Liabilities. When you sum them, you're going to have 700,000 is equal to 700,000. You realize that at this point, the left side is equal to the right side. At any point in time, the two must be equal. Two main things we learn from this. For every transaction, there is the dual effect. And that is what we spoke about earlier under our accounting concepts and principles. The dual effect. So the debits must always be equal to what? The credits. The left side of the accounting equation must always be equal to the right side. Now think of this. The business makes a sale. So it sells goods worth 500 or let's say 5,000 Ghana cedis. 5,000 Ghana cedis. What happens here? At this point, it will receive, and they sell it for cash. So at this point, they will receive money of 5,000, and then they will record what? Income, which we will call revenue, also of 5,000 Ghana cedis. Now this is where the interesting part comes in. Everything that is being done in the company is being done for the benefit of who? The shareholders. Because it is their money that has started the business, and they are the ones expecting to be the residual beneficiaries of the company. So when the company transacts, whether it is revenue that comes in or an expense that goes out, ultimately it goes into what? The shareholders' account, which we are calling what? Capital. So now that we have sold goods for 5,000 Ghana cedis, we are going to receive cash. What will be impacted? Of course, our asset account, our cash account, will increase by 5,000, and then now revenue has also gone up by what? 5,000, and we said revenue is ultimately going to be beneficial to who? The shareholders. So we go into the shareholders account, which is capital, and that is going to go up by another 5,000 Ghana cedis. Does this make sense? Great. So now we are going to have the equation becoming 705,000 for assets is equal to 505,000 for capital plus 200,000 for liabilities. So you have 705,000 is equal to 705,000. Now we make payment for an expense during the month. We pay electricity bill. We pay cash. What is going to happen? Our cash account is going to reduce. Correct? Good. And our expense will also come in. And expense takes out of the shareholders' residual benefits. And so on the cash side, which is on the asset side, we are going to have a minus 2,000, and in the capital account, we are going to have a minus 2,000 as well. So now what will the equation become? It will become 703,000 is equal to 503,000 plus 200,000. Does that make sense? So when you sum it up, you're going to have 703,000 on the left side is equal to 703,000 on the right side. Let's take the final example. Now we decide as the company, Bonsu and Sons, to pay off a part of the loan, which is currently 200,000. So we decide to pay off 50,000 of it. So we are paying out cash. So our cash account is going to what? Reduce by 50,000. And once we pay a portion of the liability, that liability is going to reduce by that 50,000. So what is it going to be now? So we are now going to have the 703,000 minus the 50,000. So that is going to give us 653,000 under assets, which is going to be equal to the capital account, which is currently how much? 503,000, plus the liability account of 200,000 minus 50,000, because we are paying a part of it. So that is now going to be how much? 150,000. So you are going to have 653,000 is equal to 503,000 plus 150,000. When you sum the right side, you are going to have now 653,000 is equal to 653,000. Good. So now we are done. That is the accounting equation and the impact of transactions on the accounting equation. So in this lesson, so far, we have been able to learn what the accounting cycle is, and we learned that it is the 5 main activities of initiating transactions, which is done with source documents, recording transactions, which are done in the books of prime entry. There is the processing and classification of transactions, which are done in the principal books of accounts. Then there is the summarizing, which is done in a trial balance, and the reporting, which is done in the various financial statements. We were also able to learn what the accounting equation is, and we learned that it is basically the company's assets being financed by the contribution of the shareholders and the loans and credits from various lenders and creditors. So we have assets is equal to capital plus liability. Simply put, A is equal to C plus L. And we're also able to ascertain the impact of various transactions on the accounting equation. I hope this has sat well. This has been episode 5 of Making It Count, Legal Accounting Made Easy with Benji. My name is Benjamin Ofeado. Let's meet on the next one.